name's Alex Rodriguez, reminding you,
You don't need a contract. You need a team of pros. Hey everybody, Alex with Bay Cities Construction here. Welcome to the Construction Show. I've got some friends. We're going to be talking about commercial lending. If you have a building, you've got a property that you need some money for, you need some advice. I've got two pros here in the studio. We're going to talk about everything commercial lending. So stay tuned. Hey guys, welcome back. I want to introduce you to these two gentlemen from Tauro Commercial Lending Services, or actually Tauro Capital Advisors. Can you guys introduce yourselves for our audience and tell us a little bit about your business, or tell us a little bit about yourself. We'll get into your business in a sec.
Sure. I'm Steve Stein, managing partner for Tauro Capital Advisors, and thanks for having us. We really appreciate it. The show's great, and we're appreciative to be here. My background is I've been in the real estate industry for almost 30 years, started in 1990 as a commercial real estate broker for a company called Marcus & Millichap. And from 90 to 96, I sold apartment buildings in Phoenix, Arizona, and then came to Southern California in 1996 to run brokerage office for Marcus & Millichap in Long Beach, and I was there until 1999, and then transitioned to the Los Angeles office, and I was there until 2012. And when I left Marcus & Millichap, went to work for another mortgage brokerage company in Century City, and then in 2014 started a little bit different version of Tauro. It was Tauro Real Estate Investment Services, and basically was in-house for a developer here in Torrance that does single-tenant, multi-tenant retail, mostly in Southern California, some in Northern California. And then about 2 years ago, reconnected with somebody that I've known for a long time in the industry, and we created the version that we have now, which is Tauro Capital Advisors. And Tauro Capital Advisors, we really are an advisor as opposed to doing transactional work on the debt side. And we help clients source debt and equity around the country.
Cool. I mean, you have an amazing depth of experience. And who's this good-looking fellow here next to you?
Alex, how are you? I'm Avi. Thank you for having us on the show.
My pleasure.
Avi from Boston originally. Grew up, born and raised out in Boston. After high school, decided to go out to Israel for a couple years, where I became a medic for the Israeli Red Cross. And after doing that for a few years, kind of got a little bit hectic. I decided to come back and work with the family for a little bit. And somewhere along the line, I got a phone call from my friend saying, "Hey, Avi, I have a job that would be perfect for you." I'm like, "All right, perfect. Let's check it out." Next thing you know, I'm on my way to New York to meet my friend, and he starts showing me his paychecks, and I'm like, "Wow, this is an amazing way to make a living." And I kept asking a little bit more, and I kept learning about the business more, and I realized, after being a medic for so many years and helping people, get back on their feet, I was like, why not do it with finances?
Sure.
Because it's something that I've always been interested in, finance, my entire life. And I figured, okay, let's start helping people with finances. And I've been with Steve here for about a year, and he's one of my mentors in the company. And we're very excited to be here. So thank you for having us.
Man. Well, I'm excited to share with our audience what it is you guys do. I know that as the stock market had a very interesting finish last year, I think some folks are kind of starting to look at taking inventory of their financial house, right, and are maybe considering that times may be changing, and maybe considering what to do with their holdings, right, with their real estate holdings.
Right.
Hey, I can't switch over this one. Okay, cool. Sorry, technical difficulties. Yeah. Hey, so just want to recap real quick. Our last episode, we talked about the natural disasters. We also talked about and basically was to bring some awareness to being here in the South Bay, or being here really in Southern California, and what we're facing with. So hey, if you haven't had a chance to take a look at that episode, it's episode 27. It's posted on YouTube. So please, if you didn't catch that last week, go ahead and check it out. So tonight's episode, we're going to talk about money. We're going to talk about apartment buildings. We're going to talk about commercial real estate, and having a deeper understanding in how to source capital, right? So either loans or also raising talking about private equity, right?
Right.
Okay, cool,
Yeah.
cool. So I want to make sure that you guys are on board for that. So so as you guys are now as a company, you've talked about your evolution over the last few years. Where are you guys at now? Where do you bring the most value to your customers?
Well, I think we bring the most value to clients because we take a little bit different approach that I think people in our space do. And as we talked about before the show, we really are focused on the level of care that we give our client. And that's really something that all of us take to heart, because we understand how important the real estate is that may be financed. And when Avi mentioned about helping people, we truly are helping them through sourcing the best debt and in some cases equity. And in a lot of cases, it's not only the interest rate, it's, as I mentioned earlier, the covenants that are in a loan that can be very tricky and unfamiliar to people, because this isn't something they do every day.
So when we're talking about dollar figures, when you get to kind of what dollar figure level do we start experiencing these more complicated covenants from the institutions that provide the lending?
Well, I mean, you can see them even in small loans.
But what's a dollar figure? What would you consider small loan?
I mean, even if you're on a $100,000 loan, I mean, some of these same covenants could be in a residential loan, usually not. But I would say if you're looking at $500,000 or more, and then as the dollar figure grows, there's usually other covenants and other loan documents, because when someone takes out a commercial loan, there's just not a note or a deed of trust. And so if you're unfamiliar with a note or a deed of trust, the note is the promise to pay.
Right.
And the deed of trust is what secures the lender's interest. But there could also be other guarantee agreements, environmental agreements, security agreements. There are a lot more to just a loan than the note.
Well, most definitely. Here in California, there's some institutions that are requiring the software retrofit to be done. There's others that require fire sprinklers, certain other improvements in the buildings, or additional insurances to be held, right? Stuff like that. Brian, can you bring in that monitor a little closer, because I can't read it from here. Sorry. I'm about to turn 44, and it's gotten a little different.
Yeah, one thing that you mentioned about the stock market.
Yeah.
There's another topic that came to mind that we can talk about what people can do and how they can get actually involved in lending.
Okay. Yeah, let's talk about that.
Yeah. Right.
So, sorry, I can't see that. Okay. Let's go. Thank you. So let's talk about what are the territories that you guys provide your services in?
We're really not. We don't have any boundaries as long as it's within the continental United States. We do everything. We do even the hard states, Alaska and Hawaii. Most of our business this past year, believe it or not, half of it was out of the state of California, and we were able to acquire and secure really amazing loan programs for our clients all across the country. So it's not really that we have a boundary, it's just more of the right client and making sure that we can help that client. Because if we can't help that client, then be it in LA, be it in any other city, we can't really
So Avi, what do you think from your portfolio of transactions or deals? Did you see a cluster, like a heat map of regionally where that stands out that you've done some deals?
Southern California has always been a very hot market, and it will continue to do so for the next, I think, in the near future. We've been seeing a lot of movement, I would say, out in Texas as well. There's been a lot of transactions happening out in Texas. New York City is always one of the cities where you'll see a lot. But we've also, Steve here just actually closed a deal, secured a loan for someone out in North Carolina, and that was, apartment building complex, and it was in a part of the state where it wasn't that particularly familiar.
How big of a building was that?
Well, it was actually what they call a fresh earth condo project. So it was 82 condo units within a much larger condo project. But one of the things, especially on your question on the territory, what we're seeing is, good and bad, California is a great place to own real estate. So that's great because it maintains its value and typically rises. The downside to it is the return on people's investment is much lower here than it is elsewhere in the country. So what's interesting is a client could buy a Starbucks here, or let's call it a Chase Bank here in Southern California, and there's a term called cap rate. And for those in your audience that really aren't familiar with that term cap rate, you look at cap rate as similar to the interest rate you would receive in a bank. If you put $100 in the bank and you're getting 2% interest on it, that would be a 2 cap on a building. So for example, a Chase Bank here would sell for what we would call maybe a 3.5, 4 cap rate. So if you had that same Chase Bank, so it's the same credit, and that was in Kansas, and there's nothing about Kansas for those listeners that you have from Kansas.
Right.
That's probably going to trade mid-4s, high-5 cap rate. So again, same credit.
Sometimes double the return.
Could be. I mean, again, it's the same credit. Building could be the same, but it's just where the perception is. So cap rate is really an indication of perceived risk.
Sure.
That's how it gets adjusted. So that's why we go around the country. And even when I sold real estate years ago, there was always known as the California money because it was people leaving California for the better return in other parts of the country.
Sure. Yeah, so you cash out the equity and you reinvest it somewhere else where you get a lot more size for your
Right.
money, right? Like when you get a bigger house for way
Right.
less money, you get a bigger building.
Right.
For
And you see that in the residential, as
Sure.
I'm an empty nester. I know we talked, you're probably pretty close too.
Yep.
And people start reevaluating,
Yeah.
and they look at states like Idaho, Montana, or could be Texas or Florida where there's no state tax, but they look at where those values are. I have a friend that just bought a 2,700 square foot home at the Biltmore in Phoenix, and he's in escrow at $960,000. It'd be twice that here.
Yeah, no, that's true. I think especially now, people are worried about where we're going in California with the higher taxes because they're talking about spending some more. I think we're going to see a new wave of spending.
Yeah.
Without the politics in it, I think that's just the dynamics of where these conversations are going. Right, we're gonna build a high-speed rail to San Francisco that's going to cost a fortune.
Right.
We've got to pay for that back. We're talking about expanding a lot of the social programs, so you need money for that, which
Yeah.
means higher taxes, right?
Yeah. One of the things I was going to mention too about expanding across the country, you do have people that want to leave California. What they have to also realize, though, they have to do their homework, and I know we'll talk about that later on. But there are 8 states in the United States that actually charge a mortgage tax. So if you put a loan on a commercial property, in addition to all the other fees, you're going to pay the state a tax, and it could be as much as 8%.
Wow. What are some of those states?
Florida's one.
Okay.
I think Kansas is another. And so there's, like I say, there's 8 states. I think Alabama's another state.
Okay.
The reason that I know about it is I actually did, my largest loan I ever placed was in Florida. And it was north of $100 million. And there was an $800,000 mortgage tax bill. That
On a yearly basis?
No, it's just when you place the loan.
Oh, okay. It's
Yeah.
a one-time thing.
Yeah, when it funds or when it actually, and what's interesting is it's a construction loan. So construction loans don't fund all at once,
Yeah.
but the tax man collects on
Oh my
the face
God.
value of the note.
Wow, that's amazing.
Yeah,
It's amazing how they work that out. How that
yeah.
doesn't work out. But let's talk a little bit about. I think that we should definitely get into some of the what you guys see as a hot spot, as kind of what we want to give the audience is kind of an insider view of where you see the trends going. So if you were to give people advice on, we talked about this before the show. We talked about how the real value of in our business and in your business is that we want to be advisors to folks, right? To
Right.
be able to give them a good, non-biased advice and be able to look at their total situation and be able to give them good advice based on that.
Right.
If you were to give folks a little glimpse of kind of behind the scenes, where do you see some opportunities for lending, for acquisitions of property? What are your thoughts about that based on what the market is telling you now?
So on opportunities, it's interesting. There's an opportunity that most people may not even think about because you mentioned a few minutes ago about the stock market and the low returns there, or it's volatile, and that scares people. there are people that have IRAs. There's a form of an IRA called a self-directed IRA. And that's something, if people are interested, they should talk to the various companies. They can Google it or talk to their accountant. What's interesting in a self-directed IRA is it's just that, self-directed. So if they have money in the stock market, which they're unhappy with that return, they can actually loan money to commercial real estate and create a deed of trust, and that's allowable under the tax code. So for example, if you needed $100,000 or $1 million for a project and you had a friend who had a self-directed IRA with that amount of money in there, they could actually create a note and deed of trust and lend it to you at 6-7% or whatever you guys agree to, which would be better than the stock market. That real estate's not going to move as much, and it will get a return.
That's amazing.
Yeah,
that's really cool. So how, if you were on in that position where you had money to lend out or to invest, how would you find the deals? How are deals found?
a couple ways. I mean, through commercial real estate brokers, if they know them, or folks like Avi.
We'll do our homework on the property and make sure it's a smart and wise investment for you.
So let's walk through that. Like, what does that look like? I tell you, hey, Avi, man, I just sold, my spec house. I've got $5 million, free cash to invest into a deal. What, from that point on, I tell you what I got, and take it from there. What does that look like?
Well, at first I'd say, what would be your long-term goals? Where do you see yourself going? After selling this spec house, what do you want to do with that capital? Where do you see yourself in 10 years? And what I would do from there is I would, listen and take all of that, and then really take a couple of days and think about it and figure out what's the proper channel, proper way for you to invest your money. So if you were to tell me, Alex, hey, listen, Avi, I just sold this spec house. Now I want to get into retail centers. I want to start investing in retail centers. But you've never had the experience with it. What I would do is I would go look around, find a retail center, or if you were to find a retail center, send it over to me. I'd make sure the retail center has the proper net operating income, the taxes aren't too high, and there aren't any hidden surprises for you waiting for you right after you buy it. So that's what really our job is to make sure that your long-term goal is protected. That's like the biggest concern that we have, is to make sure your long-term goal or even short-term goals are protected. So one would be is through extensive underwriting that we would do on the property to make sure that the property is eligible for financing, or as I said, there are no hidden surprises.
And if I wanted to just to be the deed holder, like I didn't want, I don't want to own it. I don't want to bother with the tenants. I just want. I mean, that's really the reason people do that, right? I mean, because they just want to be in real estate without being in real estate,
Right.
So what does that look like? Like if I'm ready to do a $5 million investment as a deed, as a
lender.
As a lender, yeah.
Yeah, I mean, so typically those loans will be what we call bridge, not really hard money loans. They could be soft hard money, or they could be hard money loans. We would just understand how much money you want to invest, and like Avi said earlier, really kind of what are you trying to accomplish? So what's the horizon? When do you want to be paid back? Are you okay holding that note for 10 years as long as you're getting paid, or
Sure.
did you want to hold it for 3 to 4 years? So once we understand what your parameters are, we have requests all the time for bridge or hard money, and some of it is because, like for example, there may be somebody that hires you to renovate an apartment building. They just bought it, not well occupied, or a retail center, whatever it might be. The occupancy isn't where it needs to be, and so you cannot go get a traditional or conventional loan on that, because what they call is the net operating income of the property isn't going to support the loan. So you get a bridge loan, and as part of that underwriting, we include what they call interest reserve. So that's part of that. So realistically, what an interest reserve is, the lender is loaning their own interest to you, and that's part of it. And so that could be an opportunity. We would explain, because there are pitfalls to all of that. At the end of the day, because you have a deed of trust in the state of California, you can foreclose. Obviously, that's not what you want to do.
Yeah,
so you have to do due diligence. And as Avi explained, we have underwriters at Tauro that will go through all that, because when we look at these, we get a much deeper level of due diligence than commercial real estate brokers do. It's got nothing to say that they're not doing their job. It's just not as what they do. They don't need that level of due diligence. We have to scrape the surface, because like Avi said, we want to make sure that it is financeable. And so, like for example, when you have a commercial building, let's say you have 5-6 tenants in there, the lender's going to, and I know it's a little bit different than what we're talking about, but the lender is going to look at when those leases expire and hit you for tenant improvements or leasing commissions. So if you have $5 million to invest, again, we want to understand what you want to accomplish and then make sure that we can find those opportunities that match your goals. And the other thing is because what we, and we'll talk about I think later on in the show, is that as we all know, life changes. And so if you're a lender and you said, okay, I've got this $5 million that I want to lend, you're going to be stuck for that period of time that you've agreed to lend it to.
Right.
And so you just want to make sure that you haven't used all of your resources and that you plan for unexpected things.
No, that makes sense. That makes total sense. So I think it's really an interesting. It seems like you have a full toolbox, right, for moving money around,
Right.
and as it pertains to real estate. So that's a really cool deal. So let's talk about 3 trends to look out for. What do you guys think? 3 trends for 2019 that have caught your eye so far.
One of the hottest things on the market right now, I would say, is the opportunity zones that the IRS came out with recently. The government pretty much, they're leaving it up to state by state, but they pretty much said they wanted investors to start investing in urban low-income areas. And what that means is they give the investor incentives to invest in these places and develop the properties in which they purchase. Not every single property is eligible, and it's up to state by state where they designate these certain areas. But if you can do it in the right way, it's a great investment tool and investment.
So what is the actual incentive that they give you?
So you are allowed to defer capital gains tax until 2026.
Holy smokes!
Yes.
It's only federal though.
Only federal.
Right, but that's still
It's a lot of
15% of a big number is a big number.
Correct, but there are a lot of misconceptions around it, and you have to be make sure you go into the code and read it and make sure it's used to your best of knowledge and best tool. One of the things that's very important for investors and your viewers to know is that it's not for any sale that you've made in the past 10 years or so. It's from a specific time period. So starting from December 22nd, 2017, all the way to December 31st, 2026. From any time during that period that you make any capital gain, that capital gain you can defer that for up to 10 years if I'm not mistaken.
Wow.
Until 2026. But Steve, do you have anything else?
Well, what's interesting also is because some people that watch your show understand real estate and they're familiar with what they call a 1031 exchange,
Sure.
where you sell a building and then you have to defer the capital gain by buying another building. With the opportunity zone, it's, as Avi mentioned, it's any capital gain. So if you own a Picasso and you sell that and you make $100 million, you can use that $100 million in an opportunity zone investment. But it's fairly sophisticated, fairly complicated. You have to create what's called an ozone fund, opportunity zone fund. And that's the vehicle. And then there are certain requirements that when you buy a piece of property, let's say you bought a piece of property, call it a shopping center, and it's $10 million. So they're gonna take out the land value, and you'll now have the bricks and sticks value. You have to double what that value is. So if the bricks and sticks are worth $5 million within the certain time period, you have to spend another $5 million on the property. So they're looking for you to improve it. So for people that are interested in opportunity zones, it's really critical that they not only discuss it with their accountant, they should do that anyway, but also find a very good opportunity zone attorney that really understands it. And it's still fluid. It's still changing.
Well, that's like with any new regulation, right? It takes a while for everybody to understand all the facets of it.
Right.
Couple things more I'd like to add to touch on what Steve was saying. First thing is that most commercial properties, are eligible. The only 2 commercial properties that are a big no-no are liquor store and massage parlors. Don't ask me why. That's how it is.
Aren't those opportunities though?
It can be.
And another thing is that you have about 180 days from the capital gains, whenever you make a sale, to deposit into a qualified opportunity zone fund. And from there you have 6 months or until December 31st of that year to, it's similar to a 1031 exchange, you have to identify another opportunity for yourself to invest the money in.
So it's a mechanism actually for expanding the time, because 1031 exchange is kind of a narrow window compared to this. It seems like if you can go up to the end of the calendar year and you had a transaction at, let's say, November. So walk us through that.
It's not from the end of the calendar year. It's from the date that you put the monies into the Opportunity Zone Fund. You have about 6 months and to identify another opportunity, and whichever comes first is either 6 months or by December 31st. So if you
I got you. Okay.
so if you put your money in September, you have until December 31st.
So if I sold something in November
Mhm.
last year, I got 180 days to open up that fund, and then I've got another 6 months to actually identify something and close, or is it just identifying a property?
Well,
Do you have to close?
one thing that is sometimes people don't realize is when you sell something and you have a capital gain, and what Avi was talking about December 31st, you have to complete it within that tax year. So even like if you did it in September, if you want to do something, and it's the same thing with the 1031 exchange, the only way around that is actually with the exchange is if you extend your filing. So it can so like in a 1031 exchange, you also have 180 days to complete it. But let's say you sold your property on December 1st, you'd only have 30 days to actually complete it unless you extend your in your filing deadline. So that's something that you need to understand. That's why we say these things are very complicated and very fluid. So it's really important to talk to the professionals that are up to speed. In this instance, we understand it in a cursory view, but this is not something that you would take what we have to say as gospel. It's really important to really understand it. If someone's interested, they can Google Opportunity Zone Map. It will come up.
Oh, that's cool.
And as Avi said, it is picked by the governor of every state, and there will be some interesting places that are opportunity zones. San Juan, south of here, oddly enough, is an opportunity
San Juan
zone.
Capistrano?
There's a big portion of that.
Oh, wow.
That is an opportunity zone, which you really wouldn't suspect. So
That's true.
you just have to look at that and be mindful of where you can and can't go.
Okay, cool. What's another one here? So that would be your first trend. Was that your first trend?
That was my first trend.
What's your second trend?
Second trend would be Measure JJJ. That was passed in, I believe, November 2016. Was that when we had the primaries for the California primary?
Yeah.
November 2016. Measure JJJ is something passed by the city of LA, so I'm sorry for all your viewers who are outside of Los Angeles. The city had passed it pretty much. It's allowing investors, what they want to do is they want to make more affordable housing. And how they're going to do it is they're going to go around, most of the people who are in affordable housing don't have cars, don't have their means to get to work. So what did they do? They said, okay, let's do this. We'll find every single major bus stop, train, or any major mode of public transportation, and anything from that bus stop to about half a mile out, they're going to be giving them incentives. And what that means is they're going to allow you to increase the density of your property. So if you're a developer that owns a property, let's say in downtown LA is a fantastic area because there's so many major bus stops and train stations, and you own a property that currently has it has to also have above 10 units. If you have a property that has 10 units, you are able to increase density at the lowest by 30%.
Wow.
But that comes at it with a catch. The catch is you have to at least put, if you were to increase it by 30%, out of that 30%, out of total units that you have to give at least 5 to anywhere from 5, depends if you're renting or selling, but it's anywhere from 5 to 20% of it has to go to affordable housing. And within affordable housing, there are 3 tiers. There's extremely low level, then there's the low level, and then there's low poverty rate. So they have 3 different tiers, and within that, you just have to look, and if you go on Google and you just type it in, you'll see all types of useful information on what tier you might fall into. Another thing that it does is that the city of LA was like, okay, let's also boost the economy by doing this, and how are we going to do that? So if you're going to start doing construction on a property that is qualified for the Measure JJJ, they will tell you that you need to at least have 30% of the construction workers working on that property to be living to live in the city of LA,
Okay.
to be certified by both state and the city of LA. So
Okay.
they're trying to a little bit. It's like a little.
So they're verifying that their workers live in LA.
They want to pretty much use workers out of LA.
That's not difficult to do.
It's not difficult to do at all. I think it's a great program. I think it's a great program for any investor who's seeking to buy, maybe a distressed asset, it would be great to take it, develop it, and you can increase your density about 30%.
So this is a personal question because our family, we do own real estate in LA. So let's say our family owns a 10 unit, I think it's a 12 unit building actually. It's 2 small units. A 12 unit, and about 2 years ago I looked at city planning, and we considered knocking it down and building a bigger building. And I think the most that we could have gotten out of it was like 18 units, which by the time everything was said and done, it didn't pencil out. So potentially, if that area for the space, the max was 18 units, potentially I could go 30% bigger, which would mean maybe 24 units, something like that. But prior to this bill, actually I probably looked into that maybe 3 or 4 years ago. So in a building that before this law came out, let's use some round numbers. Let's say it was 20 units. Hypothetically speaking, in that same footprint, you can now build 26 as long as part of those units are allocated the way that you described.
Correct. And there's also one more thing you have to keep in mind, that it's not only just up to 30%. You can go up to 3 stories high depending on the tier of how far you are. So if you're 750 feet away and you have 2 major bus stops around you, you can add on 3 more floors to your building.
Yeah, I think we're just going to sell that property.
That's somebody
because now it's worth a lot more money.
Yeah.
Yeah, it's funny. We had somebody offer. This is my dad's building. We had somebody offer like $2 million, and my dad's like, $2 million? What are you, crazy? This is downtown LA. And there's a backstory to that, because he had a building within the footprint of LA Live.
Oh, wow.
He owned that building. They were using, when they bought that building through eminent domain, the developer used comps from the city of Maywood. Maywood, that's right, Maywood. That's like comparing downtown LA to like a Bellflower. Nothing wrong with Bellflower, but it's not downtown LA real estate, right? Or I don't know, Lancaster. Maybe I'll insult some people from Lancaster better. But so it's not, you know what I mean? So even when they offered him that, there wasn't anything that sold for those price points. But with these new laws, it's important for people to reassess, because the truth is he doesn't make a lot of money. He's got a lot of rent control buildings in there, a lot of rent control tenants in there, and he keeps the building up. It's a nice building, but he's retired, so you need as much money as you can when you're retired.
Right.
So very interesting conversation. So what's your number 3?
Third trend is right now is a great time if you're a multifamily apartment owner to refinance a loan that you have, because rates have been low. And August of 2018, you would see rates for multifamily ranging anywhere from 5% to 6.5%. Recently, we were actually able to close, which we'll discuss. Later, we were able to close loans right now for anywhere from 4, depending on the borrower and their background. But we were able to get loans closed on them at 4%.
That's amazing.
That being said, if you're a apartment building owner and you're stuck in a really bad loan and you want to get out of it, right now may be a good time to refinance, because rates are very low. Also, but you have to also check, if you're an apartment owner, you should check to see you have no prepayment penalty or anything like that, because you can't just get out of your loan. You gotta, as Steve was mentioning before, they try to keep you in there as long as possible so they can make their money. But our job is to make sure that doesn't happen. So if we were to get a loan, we try our best to secure your loan that would not prohibit you from leaving whenever you decide.
Cool. Well, hey, should we take a little break right now, Brian? I think we should take a little break. Hey guys, don't go away. We got some more. We're going to be talking about industry trends, so don't go away. We'll be right back. Hey folks, we're back here with our friends from Tauro Capital Advisors, and I wanted just to share with you some of the maps Avi had talked about before we took the break. Avi talked about the opportunity zones, and we have a really cool map here that we want to share with you. So we want to bring that up on the board. So right here, so kind of walk us through this area, Avi. What on this map? What does this represent in Greater LA? This is pretty much LA, right?
Yeah, pretty much LA. Not all of LA. I mean, LA County's pretty big, but I can't see the map that well. But if you can see most of the dark blue zones or the opportunity zones, and all the way down from downtown going south, where there's a lower income and urban, that's where most of the opportunity zones are. But you can also see like little spots of West LA where it's predominantly an affluent neighborhood. In affluent neighborhoods, you'll find spots where opportunity zones would be, they've designated them as opportunity zones. And I don't know if you have anything else you'd like to add.
No, I mean, it's like I say, it's the map across the country is available on Google. And it's you can move it around. You can type in an address and find out if it's something that qualifies under the opportunity zone.
So you had also measured JJJ, mm-hmm. and that's a Los Angeles specific ordinance, right?
For Los Angeles County.
Okay, cool. So you're looking for the transit spots.
Correct.
Man, I think I'm going to give my dad some good news later on today. All right, so let's talk about, we did talk a little bit about where interest rates are trending. Where do you see, okay, this is like kind of like the trick question, right? Where do you see rates through this year? I mean, I wouldn't ask you like for the next couple of years, but what are your thoughts? What's your pulse, your hand on the pulse telling you?
Sure. Well, interest rates are historically low, even as they've risen lately. So, a lot of people ask, with the Fed rate, how does that affect commercial lending? Generally speaking, it really is not that much of an effect. There are some lenders that price to that, but most loans that we work on are priced either at the 10-year treasury or what they call the 10-year swap, or realistically, it's actually, if you do a 5-year term, it would be a 5-year treasury or a 5-year swap. Construction can be priced to LIBOR, which will float. And you can have floating rates on various indices. So, but generally speaking, rates are low. Like Avi said, we closed the loan at 4%. That was fixed for 5 years. Really interesting product that we have. One of the lenders, very creative. This loan is fixed for 5 years, and it's at 4%. And there's a prepayment penalty, so it's 5% the first year, 4 the second, 3 the third, 2 the fourth, and 1 at the end. But at the end of that 5 years, you can pay it off and get another loan. But if you choose to stay with this loan, the lender has agreed to not raise the rate more than 50 basis points. So you're at 4. The most it will be in 5 years is 450. And that's tied to the 5-year treasury. So if the 5-year treasury is at 7 or 8, you're going to be at 4.5%. What's also interesting about this loan is they recast it based on the new balance. So what I'm talking about is when you have a loan, it's going to be amortized. Apartments are usually a 30-year amortization.
Right.
So if you have $1 million loan, in 5 years the balance might be $830. So it doesn't go down much. But when they reset that loan, they're going to do it at that same margin above the 5-year treasury. So what we're talking about with the margin, for your viewers who may not understand what that is, you'll have the 5-year treasury plus 230 basis points is what they say. And that would be 2.3%. So let's say we're at the 5-year treasury plus 2.3%. In year 5, or let's call it the beginning of year 6 actually, they'll look at what the 5-year treasury is and 2.3%, and let's say the note should be again 7%, it will be 4.5%. So the lender will actually lose money on that loan. The other thing, when I talk about recasting and the amortization, they'll now look at that, let's just use $830,000 as the balance, they'll use a new 30-year amortization schedule. So in an instance where it's 4% today, and for whatever reason it happens to be 4% in year 6,
right,
your payment actually will go down because it's now amortizing a much lower loan balance. So it's a great product. So lenders are getting very creative. We don't really anticipate that loans or interest rates are going to go up much unless something happens that is unexpected.
So you feel that the money markets are going to be pretty stable through the end of the year.
I do because right now it's not an election year, and so that usually moves the money around. Again, unless there's something that's unexpected that happens, we're probably going to be pretty close. I mean, if you looked at the 10-year Treasury a few weeks ago, which is what people usually use as a benchmark for all commercial real estate, to just look at it to kind of get an idea, it was over 3%. I didn't see it today, but it was just under 2.7%, which is a movement of over 30 basis points. That's a big difference when you look at loans.
Sure. Absolutely. Well, thanks for sharing that. So let's talk about some of your recent projects. I'm actually pretty excited to learn a little bit more about them. So tell us about this big, beautiful building here, the Hawaii City Plaza.
This is one project we're actually currently working on. It's a ground-up construction.
Oh, wow.
In Hawaii. So before you said what parts of the country do we service, we also do Hawaii, and Hawaii happens to be one of the hardest states to secure a loan in, simply because they have all these rules and regulations, and there's only a few banks or local banks who will really lend out on it. And the team at Tauro actually did a great job finding and underwriting this project, because it was very hard. It was also for an investor.
Oh, wow.
So we were able to secure for 24 months, $66 million of interest only.
Wow.
Yes. One more thing about Hawaii is that they require you to hire all local labor.
Oh, no. Well,
So if you're gonna,
but it's hard to bring in labor.
it's hard to bring in labor, but labor out there, as you know, costs a little bit more.
Yeah.
Hawaii's an expensive state.
For sure.
So if you're ever gonna invest in Hawaii, make sure you do your due diligence and your homework.
Right on.
Because it's
How long
definitely.
did it take you guys to source a source?
It was a while.
Yeah.
It was a
it's
while.
hard
So
to-
this is, every project is different, and so we have different things that we have to deal with. As Avi said, this is a Chinese national. This actually has what's called EB5 money as part of the capital stack. So the capital stack is all the money that's raised, and EB5 is a program the government started a number of years ago, where Chinese nationals who want to get their visa can invest $500,000 into real estate, and there's certain rules and regulations. And so they raised a chunk of the capital stack as EB5 here, and that has some play as far as the lenders are concerned for priority. And priority is, again, in the event that it's foreclosed, who goes first and gets their money first. So we had that we had to deal with. He's also his own contractor, and so that puts something into the mix. And why that's a problem is that in the event that they did default on the loan and foreclose, the lender now has to find another contractor, and your contractor, and
Sure,
to
yeah.
take over at the same cost that this contractor agreed to do it. So every project that we work on, and this is a great example, has certain nuances. There's no vanilla loan, and there's all things that we have to consider, and that's part of what we do.
That's amazing that you guys were able to secure that deal, funding for that. That just seems like a very challenging. I mean, the building looks like it's an amazing project, but it looks like there's some significant hurdles to get over to be able to get that deal.
There are, and one of the hurdles that we will have to get over, and it's interesting because it kind of goes back to what you talked about with your father's building in the beautiful city of Maywood, that they use comps for that. One of the things that a good capital advisor has to deal with, or everyone has to deal with it, the good ones I think are successful, is really kind of shepherding the process and making sure that the appraiser is correct. Because you talked about Maywood. We closed a loan in Ventura. There's a multi-tenant retail on Main Street in Ventura. And the loan came in short. And the loan came in short because of the appraisal. And when we looked at the appraiser used a vacant bowling alley in Encino as a comp.
Yeah.
And so that's part of that process. So I don't think we're going to have that problem here, but it is something that we do as part of our level of care.
Yeah, no, it's you have to get, for these deals, you have to get so many people to agree to look at the deal the same way, or through compromise to get to the point where they're
Right.
okay, I'm okay with that, I'm not okay with this, and be able, like you said, to shepherd the deal through, because
Right.
There's a lot of people involved,
Well, and the other thing is, more so on construction, but it can be for other, is the time that we have to spend underwriting the transaction. Because in contracting, you get a loan, but you're not spending it all at once, right? And so the lender wants to know exactly how that money is going to be spent. And we also want to know, because you're paying interest on the money that you spend, not on the loan amount. And so we have to schedule that, just like you do in your contracts. You're scheduling your time and your resources. We're scheduling those as well, so the lender understands that. So there's a lot of movement that goes around. And then on a construction loan, it's always predicated on the takeout loan, because obviously the construction lender wants to be taken out, or if they're going to do a construction of perm, they also want to make sure that the perm loan conforms to what the regulators want them to do. So we have to do a lot of underwriting on that. This is a condo project. So one of the challenges on this is we have to figure out when these units are going to sell. And
Right.
so, because that's all part of that takeout process. So all these have their interesting challenges.
That's pretty cool. That's pretty cool. Well, I mean, that's why we wake up in the morning to do, to deal with
Yeah.
these kinds of challenges. So let's talk about this one here. This is Dos Caminos in Ventura.
Yes, this is a multifamily property with about 12 units.
Okay.
This
It's a
was-
pretty big difference in profile of the property, right? So it's a pretty small deal compared to the other one, right?
Correct. Well, we wanted to give one big one small one to
Yeah,
discuss.
no, it's good.
This one was, fun to work on. The buyer was in a 1031 exchange, so we had to move very quickly to secure them a loan. One of the issues this was the loan that Steve was just referring to recently. I don't know if you can go to the next slide.
Sure.
So we were able to secure $1.3 million for 10 years. For the first 5 years at 4.5%, and the second 5 year at 5%. This happened about maybe a few months ago, so interest rates are a little bit higher. But we had a lot of fun closing this loan. There was one, the bank came back to us, said, one of the units are vacant. They have to be, rented out. And, I kept trying to call the seller's agent. Hey, what's going on? And, they said it's not getting rented out. So I personally started calling up seller's agents and, checking on Trulia every day, making sure that there was a Craigslist ad up and, that this apartment was
been actively marketed.
Yes,
Right.
marketed, correct. So in the end, we were able to secure the loan, and funny thing is, they were signing the loan documents, and we get a call from escrow saying, "Hey, Avi, you got them too much money." So we were able to secure them more money than they needed, and we had to go back to the bank saying, "Hey, our client only wanted, they had enough, they only wanted X amount."
Right. Cool. It's like it's a challenging thing. Doing your, I don't envy your jobs. Your jobs, it's a difficult deal to get so many people to agree on stuff.
We enjoy it though. Once everything comes together, it's quite beautiful when you see somebody getting their they get their keys, or when they purchase the apartment and you see their face and you see how their family looks at it. Because my family, we were immigrants in this country. When we came, my parents, they both came from Iran, and none of us had anything. And one of the ways that my father was able to go on into real estate and into all the other business that he's done was through a loan. And that loan really gave the means and the capability to really let my family grow and be where I am today, sitting next to Steve, next to you, Alex.
Yeah.
And now I'm giving financial advice to other people. So
I think that's a thing of envy, right? The U.S.'s capital markets, right? Like our ability to access capital.
Mm-hmm.
My parents are from Cuba. You can't borrow money in Cuba.
Right.
You got to have all cash. When I went to Ecuador, people buy cars all cash.
Yeah.
But there's no financing for a car. Can you imagine in the U.S. not having capital markets to finance a car?
Yeah, it's funny, and the story that you share, Avi, and that you share is really heartfelt and meaningful. So, as the owner of the company, you will not see at the end of any year a Tauro Capital Advisor ad touting how much we closed in loans. Because I'm not sure that's really relevant, because one guy says he closed $5 billion, the other said $3 billion, and that makes them relevant. We will advertise what we do at the end of the year, and what we're going to advertise is how we help people. Because it's really important to make sure, as we said earlier, we know how important this is. We take everything personal. And so if we help somebody, and I remember this years ago when I sold an apartment building to a woman, and she had an insurance policy she cashed in, and I saw her a year later, and she said, I just want to thank you because I never made more money in my life than I did through my investment there. So as we talk about our success, it's really going to be the success that we helped play a part in the people that we found the debt or the capital for.
Yeah. No, it's really amazing. It's a game changer. Having access to capital, it multiplies your down payment. You're able to get into deals that I remember this conversation with my dad, touching on what both of you guys have said. My dad's been able to retire. He's never bought one piece of stock. He was able to retire on the real estate that he's bought over the years. And he was not for his career, he was a barber. He was not a high income earner, but he was able to retire comfortably because of the investments that he made in real estate. And on all of them, he never bought any of them cash. I mean, he always had a deal.
There's a book I'm sure you've heard of, and probably your the viewing audience. It's called Rich Dad Poor Dad.
Yeah.
And it's an easy read, and it's like any other book. There's certain things that you relate to and some other things you don't. But in essence, what it talked about is exactly that. It's passive income, and if you want to buy a car or whatever the luxuries, you do it through that passive income, and that's really what you learn through investing in real estate. And I tell people all the time, even if it's a duplex and it's something that you live in one side and somebody else lives in the other, get into it as soon as you can.
Yeah, I agree. I think the sooner people get into a mindset, because there's some folks who are like, oh, I'm not going to borrow any money. I'm not going to get into debt. And there's a difference between borrowing money to go on vacation or borrowing money to go to Vegas and borrowing money to secure assets that produce income over a long period of time. Right. Those are two different debts.
Yeah.
So that's a really cool thing to discuss here and bring to the table. So I'll talk about some 3 tips to avoid some mistakes. Who's got tip number 1?
Be realistic. Despite after us talking here for 30 minutes and we've probably convinced you can go out and buy the World Trade Center or something like that, be realistic. That's the best thing I can tell you. Know your expectations, know what you can achieve. You have life is a busy, there's always things happening in life. And, to set it too high, you're going to set yourself up for failure. At the same time, you got to know what you can actually accomplish in this certain amount of time. And Steve is one of the persons who have really ingrained this into me, is be realistic with my goals. My first year at working for Tauro, he asked us to make business plans. And, on my business plan, I wrote down, I want to do this, X, Y, and Z. I want to, pretty much take over the world. And Steve, said, Avi, this is all great, and I know you can do it, but let's just work one by one. And that really helped me maintain my focus and, be where I am today. And, going out there, closing, and really helping my clients to the best of my ability without being scattered all over the place. So the first thing is be realistic, set your expectations, and, just work yourself to get there.
Yeah, I mean, people hear about these low interest rates and, these fantastic deals, and there are a lot of them out there. But you also have to take a personal inventory of what you bring to the table from the lender's perspective. We have people that come into money all the time, and they want to go build a 4-plex or 8 units or 12 units, whatever it might be. Mm-hmm. And the lender says, well, tell me about the last 5 deals that you built. So simply because you have that capital to do that does not mean you can do that. And so when we say be realistic, like we say, take the personal inventory of what you bring to the table from the lender's perspective. And also, it's great to get advice from your friend or your neighbor who did this. And we all heard the stories about people who've lost money in the stock market that way. But, really engage somebody like us, a Tauro, or other folks that do what we do, because we're in the market all day long. Next week, Avi and I and the rest of the Tauro group, we're going to be in San Diego at the Mortgage Bankers Association. And there are a couple thousand lenders, and our job will be speed dating with as many of these as we can, understanding what they do and how they underwrite transactions and where their appetites are, because somebody who was a big apartment lender last year may not be an apartment lender this year, because they have to answer to the regulators, they have a pool of funds, and they have to balance their portfolio as well. So when we say be realistic, really what we're saying is check with professionals like us. Listen to what we have to say. We aren't, the guru for everything, but we're bringing to bear our experience in these conversations with lenders. The other thing that sets us apart a little bit, which helps here, every Tuesday we have what we call our pipeline meeting, which is from 9 to 10. At 10 and then 10:30 and 11, we'll have a different lender come in and talk to us about what their funding types of deals they're looking at. So within a year, because we won't always have 3, in a year's time, we'll probably have about 100 to 125 different capital providers presenting to us
That's
in
amazing.
our office. Yeah.
That's amazing. I think that most people don't understand that, I think when folks feel like they need a loan, that they go to their branch or they'll go to a broker, but they don't understand that not all banks do that same profile of
Right.
They don't do each building, each piece of real estate, each borrower has, you got to marry them to the right actual person that's going to fund them, that wants that profile, right? So I think that, and I've known this just anecdotally from some of the folks that I've talked to over the years that wanted to do some new construction, and it's the same thing. I'm like, okay, cool. Tell me what other buildings have you developed? Oh, this is the first time I got an inheritance, and I'm about to sell my house. Between the two, in fact, one of a very close friend of the family, my childhood buddy, his dad had a 6-unit building. And he wanted to knock it down and put in multiple buildings, multiple units, a higher density thing.
Right.
And I told him, I said, and he's been playing around with construction. He's added to a few of his properties over the years. But I had just finished that analysis on my dad's building. And by the time that we were done paying back the debt, we would have had a little bit more free cash flow than we have now, because it's almost paid off. Even though our income is so much less than what it would be, by the time you service the debt and all of the new requirements for insurance and all that, we would have been where we were, but I would have $4 million, it was close to $4 million worth of debt on the property. So I kind of walked them through that scenario, and it's like, do you really want to do this, or do you want to just sell it and buy that bigger building? Because that's a different story. When you're buying a building that's already producing the income, you don't have to go through the headaches and the risk of construction. Look, I'm in construction. There's risk to construction.
Yeah.
There's this thing called cost overrun that happens a lot.
Change order.
Yeah. So people can mitigate that, but I don't think that people realize that, not like their local bank, if they say I have a relationship with like my Chase Bank or Bank of America, whatever, they may not want the loan that you require. They may not want to fund that loan. So it's really amazing that you bring that piece of information, that you guys have access to 120 over 100.
Yeah, and
lenders.
you mentioned a couple things. One was matching, the lender and the client, and then also you talked about relationship. So I'm going to start on the relationship. Relationships are important. I mean, in how you navigate through life and business, relationships are extremely important. In the lending business, though, when you have a relationship with a lender, it typically only benefits the lender, because they know you're not talking to anybody else. And so what we say is, and what we do is, we make a market for that lender. I told you a story real quick before.
Oh, I think they would enjoy that. Yeah.
Yeah, and so this was a client had a 30-year generational relationship with a bank. The bank had a loan on this apartment building, and it was a $7.5 million loan. It wasn't that small, wasn't that big, but $7.5 million. So the loan's coming due, and that bank provided them with a letter of interest to refinance the loan. And we looked at it and we said, we can beat it. And we did, and we beat it by what they call 65 basis points, which is significant because it was a 10-year loan. And we beat it with the bank they had the 30-year multi-generational relationship with, simply because we had 4 or 5 banks there ready to do the deal. So this lender had to compete. And that's really what we do, is make lenders compete for the business. And again, it's not just the interest rate, it's also other covenants within the loan. Going back to matching the right bank with the client, that has many aspects to it. And one that's probably dear to your heart in construction, because it's called funds control. And so we may have 3 banks that are all the same. Interest rate's the same, the amount of the loan's the same, all of that's the same, but how are they dealing with funds control? And for the benefit, I don't know if you've ever talked about this, for the benefit of your audience, funds control is how the bank pays the contractor.
Right.
And if the bank is slow, or if they use a third party and it's slow, that's going to slow down the project, because you have subcontractors you have to pay,
right,
and you want to get paid. Everybody wants to get paid for the work they do. So that's something else as part of that match. Again, all things being equal on a construction, and all we're talking about is a construction loan. That's something we want to make sure happens. And that's part of our due diligence in what we do, whereas you go to your relationship lender for this construction project, you could be waiting, I don't know what the longest you've ever waited, but I've heard horror stories of 14 to 21 days to get paid for work.
It's a problem. It's a very significant problem, and it boils down to like matching the right one, because a bank that does a lot of construction loans, they have a whole department, and they wire it.
Right.
It's very for pros that's their market. Like, they want to do those kinds of loans.
Right.
They're set up for it. There's a lot to be said about doing business with folks that are set up for what it is that you need. Right. When it's not a good match, it's a rough deal. It's a rough deal.
And if you're that client, or our client, your shared client, it's very stressful, because you have the contractor yelling and screaming because the subs are yelling and screaming. Everybody wants to get paid. And the bank is saying, well, we really aren't set up. So that your point is really well taken, because some lenders, we'll talk to them about construction, and the people we talk to, they go, we'd love to do construction, we're just not set up for the funds control.
Right. It's a big deal, because they're always paranoid. And look, I get it. The banks are paranoid that they're shelling out more money that's going to get built, and they're going to run out of money, and the thing's not going to get built all the way, and then it's really a very ugly scenario. I totally get that point. But when you just don't have the infrastructure to release the funds, or you don't have so there's something to be said about having experience in a particular market, right? Some contractors, they do a lot of that work. So there's some contractors that do only insurance work. There's only some contractors that do new construction work, and everybody in that space, in each one of those kind of silos, is very comfortable, and there's like a methodology that everybody is good. Like, some people are like, hey, I know I'm not going to get paid for 15 days or 30 days or whatever it is. And they will structure the construction costs to reflect that.
Right.
Because somebody's got to carry that gap in money. Right. So, but the problem is when you have somebody that doesn't have a track record of doing that, whether it's the contractor that's never dealt with bank and bank disbursements, or the lender. Like, if you have a contractor that's never been dealt with bank disbursements, and now you got to tell him he's got to hold $200K for 30 days, that's not going to go over well.
No.
So because he didn't factor that in, and he didn't go to his bank and say, hey, listen, I need to charge a little bit more money because my bank's going to charge me for this credit line, et cetera, et cetera. They're just not working in. They don't have experience working in that world, right? In that.
Exactly.
So that is this is what it's important for you guys that are watching this to understand is, like, if you're going to do new construction, you better get a contractor that does like 80% of their work new construction, because they're already set up for it. I don't do new construction. I do mostly remodels, and I do repair work. So I'm not set up for that. If I wanted to, I do understand that I need to get these things in line.
Right.
But don't treat these folks as a commodity. All the contractors are not the same. All the banks are not the same. Everybody has their little niche that they operate in, and they're good at it. So go find somebody that has the niche that you need.
Right.
That's super important.
The other thing I wanted to bring up about being realistic, a couple other points, and this is not unique to construction financing. To be realistic, you also have to understand the concept of liquidity and net worth. Because when a lender is going to decide whether to give you a loan, everything else being okay, and that's what we say about being realistic. So typically, a lender is going to want your net worth as a borrower to be equal to or greater than the loan amount. And your liquidity has to be, it'll either be 1 full year of debt service or 10 to 15% of the loan amount. And when we say liquidity, it does not include the money that you have in retirement accounts. This is money that you can actively have. It can be stocks, but just not in your retirement account.
Cash equivalent. Something
Cash equivalent.
You can convert to cash.
Right. The other concept is recourse or non-recourse. And that's something that they have to be prepared for and be realistic. And so basically, non-recourse means if you give the property back to the bank, they can't come after your personal assets for the deficit. So if you owe $1 million and they sell the property for $800,000 at $200,000, they can't come back at you. There are what they call bad boy carve-outs, but that's probably another topic. If it's recourse, they sell it for $1 million. You owe them $1 million. They sell it for $800,000. They can come after your personal assets for that $200,000. And so that also you have to be realistic too, because we have people come to us with unrealistic expectations or requests, and it's just not there.
Yeah. Yeah, it's and then as the deal becomes more sophisticated or really more complicated, those are things that, and I would say too that if somebody is searching for the money on their own or their lender, they could actually get sold a deal that they didn't have to have a recourse loan,
Right.
but because they came across the wrong person that wasn't looking after their best interest, they end up getting into a riskier loan.
Correct.
As the borrower, right? Then I mean, if the market for that particular lending are all 80% of them are non-recourse loans.
Right.
There was no reason for it that they got into it. So that, I think that's another advantage to working with somebody like
Yeah, I
this.
remember years ago before I actually got into finance, it was my first home. And I remember I got sold on a negatively amortized loan, which, hey, they said, you much lower rate. And I think my loan balance when I bought the house was $70,000. This was a long time ago in Phoenix. And when I went to go pay it off, it was $97,000. But nobody told me that.
Right.
So you do need a professional, and we all get caught.
Yeah, I think that it can't go. You can't state that enough. That you really need to work with somebody that you feel comfortable with, and that is experienced in dealing in the niche that you need. Right, like that is super important. I hear all the time. I'll give you an example, construction wise. I hear all the time when I put together a proposal for a project, and let's say the project's $100,000. And that property owner will go and talk to their friends about it, and they'll say, "Oh, I got the kitchen remodeled for $80,000 or $70,000," and then they come back to me and it's like, "Hey, Alex, why is this project $100,000? My friend or my friends said that this thing should cost like $75,000 or $80,000." What ends up happening is that they're getting advice from somebody that's not equipped or qualified to get advice. So I ask them all the time. I'm like, what makes your friend qualified to give you advice about the construction costs? And they're like, well, they got their kitchen done. I'm like, I can do your kitchen for $30,000, but it's none of the stuff you picked.
Right.
You have custom cabinets. You've got a plumbing that's from Italy. You've got tile that comes from Norway. Like none of that stuff is $30,000. So where are you getting the info? And it really takes a moment to kind of walk through like how we got to a particular price point. But what always kind of would, I guess it is a little bit irritating, is when someone that's not equipped. And many times people feel embarrassed that they're spending $20,000 on plumbing fixtures. Right. Because it's freaking plumbing fixtures. But that's what they like, and that's what they can afford, and that's what they want. And that's it, right? So it's like you're shopping for a Ferrari and you're talking to your friends who cannot afford a Ferrari, and you don't tell them you're buying a Ferrari. You just tell them you're spending $200,000 on a car.
Right.
They're like, "Oh, you're getting ripped off." Like, no, they just don't know you're buying a Ferrari, right? They think you're buying like a Lexus or
Right.
a Camry or something like that, right? It isn't a matter of getting ripped off. It's just they didn't get the whole picture of what you're buying, and they've never bought something like that, so they don't even have any background of what that costs, right? So instead of just going to friends, I think it's really, if you're going to shop for a contractor, you're going to shop for lenders, shop for folks that do what you need to get done. Right. Specifically. They're not people that are making an exception, like, I typically don't do that, but yeah, I know you, or I was referred to you. We're on my end, I'm very disciplined on taking on customers or clients for jobs that we're good at, that we have
Right.
a long history of doing, so that we can provide a good service to them. And when I give them advice, it's based on stuff that I actually know, right? But I think people really like that title, the contractor title or the lender title. They don't understand. There's all these little sub markets in each one of our industries, right? All right, so let's continue our conversation about avoiding mistakes, being organized, and asking the hard questions.
Being organized is one of the first ones because it's as important as ask hard questions, but oftentimes you see clients, they'll come in and they have nothing in order, and it really comes to a cost to them because cost them money and time because they have to go get and organize all the things.
So you're talking about like putting together a financial package?
Financial package, it could be anything. It could be from financial packages to actually, there's, believe it or not, there are investors out there who own more than 10 properties, and oftentimes it's hard for them to keep everything organized.
Yeah.
So even if you're a small-time investor, make sure you have everything organized. So if you go across, when you're ready to get your loan and you have your property under escrow, you can go to your financial advisor, or go to your bank, or whoever you go to for the loan. Make sure you have everything all put together so it doesn't cost you time and money. Because the bank will give you an LOI, letter of interest, for only a certain amount of time. If you're not ready to execute the loan and move on with it, you might lose that opportunity, and that would be like the worst thing that could happen. Because not only have you just wasted your time, you've also wasted money you've had to spend to secure the loan on appraisal and such items.
No, I get it. And maybe it's just because I'm a professional buyer of services, right? Because I sub out a bit of work and I buy a lot of materials. So when it's amazing to me when I call a new vendor that I haven't dealt with and I tell them what I need, they start taking information, but it's amazing the level of interest when I tell them, hey, listen, I bought this before and I'm ready to buy. They're like, oh, okay. Then hold on a second. Let's get together next week. Because when you tell somebody something like that, they understand that now you're ready to take action and that you're going to have your stuff ready.
Right.
So they're going to kick into another gear. So if somebody comes to you and says, hey, I want to buy this 30-unit building. It's X number of dollars. I'm ready to buy. Like, we need this deal. In your head, you're like, that guy needs to get, or that gal needs to get priority because they're ready to roll. They're ready to roll, right? I mean, I think that's a universal thing. When I went to buy my truck, I told the sales guy, I'm like, hey, listen, man, I'm going to drive this, but it's very likely I'm going to buy it. So what I was kind of saying to him is like, don't say anything stupid to not make me buy this because it's going to be sold today.
Yeah.
So I think that there's to your point, being ready, not only mentally but also having all your paperwork and your ducks in a row is really a key component to getting a good deal.
It is, and also this is not an easy road. So it's not like, so when Bank of America was started by an Italian immigrant, he took a board and put it over 2 barrels and he just lent money out. And I forget what's the Jimmy Stewart movie at the holidays where he had the
It's a Wonderful Life.
Yeah, It's a Wonderful Life. So yeah, at that you remember, there was a run in the bank and everybody came to him and he gave people money and the guy wanted to sign. He goes, don't worry about it, your word's good for me. Those days are over. And so, and it's not the bank's fault, it's the regulators require them to go through a lot of hoops, which means they're going to put the borrowers through a lot of hoops. So being organized avoids that. But even for those that are organized, it's going to be a little bit of a bumpy road, and there's a lot of paperwork that has to be filled out. So the more organized they are, the better off it's going to be, the quicker the loan's going to come. Yeah. And especially when you are in escrow to buy a property, the seller really doesn't care that you're getting a loan, even though you have loan contingency. And so they expect that you're going to do your due diligence in the time you agree to, and you're going to close in the time you agree to. So if you're unorganized, it's not going to close if you have a loan because the lender's going to come back and ask for more and more information. When we take on an assignment, the very first thing we give somebody is a needs list. And we'll do that even in the initial conversation so they know exactly what is needed. And our needs list was derived from doing all these loans, but every lender has their own set of needs. And so...
no, that's a good point, for sure. That's definitely a good point.
Well, one of the things, because we said ask the hard questions.
Yep.
It's really important for your viewers or any borrower not to be intimidated by the process, even though I said it's tough. don't be intimidated by the process. Don't be intimidated whether the loan amount, the lender, any of that. If there's something they don't understand, ask the question. They have the right to it. It'll make the process go smoother. They'll be a more informed borrower. At the end of the day, they'll be happier because they asked the question. They can't come to us and say, well, what questions should I ask? Because we don't know what they know. And so just ask the hard questions.
Yeah, I think that's really just part of being comfortable and understanding that you have as you engage with a new customer, particularly with a new customer, you start to develop a rapport and a higher level of trust, right? And you hope that earlier, sooner, better than later, this trust starts to rise at a faster pace, so that decisions can start being made, right? I mean, that's always when we're dealing with somebody who's new to our company, has never done business with us before. We want to be able to get to a point where there's that mutual trust, and for us, we have to have trust that we're going to get paid. Right. You know, we put a lot of money out first. Right. Before we start seeing some of the money come back in, but it is. I mean, we're in the people business, right? We're in the same business,
right?
We're in the people business. You have to start to develop a rapport and some trust, and really, you can only help somebody to the extent that they take your advice.
Right.
I mean, you can be an expert in any particular field, but if people don't listen to you because they don't trust you, you can't really do anything for them.
That's a great point.
All right, so we're talking seismic retrofits here. A lot of our customers, particularly the larger investors, are looking at the city of LA. They pass good laws. The city of LA passes laws that people find maybe not so good. The seismic retrofit, as much grief as it gets, it is a good law. 250,000 people in LA are live in these units, approximately 250,000. And we know for a fact that these buildings, the soft story buildings, the ones that have tuck under parking, like the one that's here on the screen, they're weak. They will likely suffer a lot of damage if they're not retrofitted. So part of our deal is we do the construction for the retrofitting, and many times these property owners have held onto the building for a long time. Some of them have a lot of equity, and some of them are doing not only the retrofit, but they're also rehabbing the units, which is a really good time because money's cheap if you're going to do that. If you got a building that's worth several $1 million and it's paid off, maybe a good opportunity now instead of using your cash to use some of that equity and
absolutely, and
get your rents paid, get your rents hiked up a little bit, be brought closer to market. So for those of you guys that don't know what we've done or what we're doing with the city, there's about 12,500 buildings in LA, another 3,500 in Santa Monica. The peripheral cities around us are going to start adopting it. There's probably another 20,000-30,000 buildings in LA County that are going to be rehabbed, and then there's some in San Bernardino. And these are buildings that were built cheap back in the 70s. Many of them were built very poorly, so they need. It's interesting that I found a potential customer. We haven't closed with them yet, but they're outside of LA. They're in I think they're in West Covina. Got a big building there. I think about 40 units, and the insurance company is asking them to do that as part of the refi. Right. So. I think this law, came into effect in LA a few years ago, but it hasn't really mattered because the deadlines. Now we're close to the deadlines right now, so people are starting to take action, and now there's more awareness in the deal. So it's something that's significant that's happening. It's going to affect the lending, and basically, I just have, for those of you that haven't watched any of the other episodes, I'm just going to kind of give you a little brief. Lesson on what a soft storage building is and how do you retrofit it. So
one quick thing else, by the way, just so you know, the lender will do what they call a property condition report.
Okay.
And so that, if it needs to be done, the lender is going to require it.
Yeah. So for those of you that have a building, you're not going to know what it's going to cost until you get some plans. So you got to get an engineer to assess the building, get some plans done. There's definitely a big gamut. I've dealt with a lot of plans that had to be redone. because that wasn't the best fix for the building. But typically, the most tested methodology is what you see here on the screen, which is basically an I-beam frame that goes over the opening. Where it goes on the building and how it's attached, the engineers will figure all that stuff out for you. But this is the most widely tested methodology for earthquake retrofitting. The companies that manufacture these, they're made here in California, which is cool. It's a local job in Riverside. And they've tested them to break them. They've actually broken them. Wow. So they know of all of the methodologies, this is the most widely tested, verified. And there's a lot of content, supplemental drawings and stuff that the manufacturers have created so that it makes the engineer's life a lot easier. So I think that this is going to be come into a bigger focus as a loan contingency, I think, as we move forward. So do we have any questions, Brian?
We do. A couple of viewers have asked some questions.
All right, so let's take some questions. What do we got?
The first question is from Mark, and I think it's a question for the Tauro team. Mark asks, are there any unique risks associated with investing in opportunity zones?
Well, I think I don't know that it's necessarily a unique risk as far as the opportunity zone. There's risk anyway in investing in real estate. And so, again, you just want to be asked hard questions on any real estate investment. So you just want to make sure that just because you are deferring capital gains, it still has to be a sound investment. So there's nothing unique to the opportunity zone outside of any other real estate. Just ask the hard questions, make sure it's sound, makes sense.
Cool. What else we got?
Another question from Jackie asks, how did the Tauro name come to be?
Well, Tauro is Spanish for bull, at least what I'm told. Although it's very funny, my son is dating a woman, her name is Kathy Tauro, spells it the same way. How we came to be, we acquired that name is I have a friend who also started a company very similar. They're in real estate, they're not in the financial part. And they were way in between the company they have now and Tauro. And I really liked Tauro. I liked what it represented because a bull is strong. And I liked the red, although you don't necessarily in the financial world want to be in the red. But I just liked the fact that it was strong. And what's really funny is we actually ran a promotion about hiring, and we actually did running of the bulls.
Oh,
so I actually got to run with my son. It was a lot of fun. But
Holy
that's
Lord.
how Tauro came to
Cool.
be.
That's a great story.
Awesome. Victor asks, what are some of your favorite projects that you've helped with funding in the past couple of years?
Well, they've all been pretty fun. Actually, this one in Hawaii is pretty fun because where we find the fun in it are really the people that we meet and their stories, but then the challenges that happen. So each of them has their own unique challenge. Part of it also sometimes is, we can go down the road with a lender and for some reason they will, bow out. So part of the fun is also making sure we have a backup lender.
Yep.
But ultimately, it's really the story of the individual and what that financing means for what they're trying to accomplish. And sometimes it comes full circle because they'll come back to us years later. And like when I mentioned about it was different when I sold the building to the lady, we've had people that will come and say this financing is great. The lender was great. It was a great match because realistically, your lender is not really your lender. They're really your partner in your building, and they have a preferred return because they're getting paid all the time.
Sure.
So it is fun, that match that we talked about earlier, making sure we have that right
Absolutely.
match.
No, absolutely. And I mean the like when we get good at our craft, you have a win, right? Especially if it's a challenge, right? When you have a win, it feels good. It feels good.
Yeah.
When somebody comes to you and says, "Man, I've been shopping for this thing. I can't get a solution." And then you're able to put something together for them that's a good deal for them, and at the end they're totally stoked. They got their property for us. They got everything out of the remodel or the repair that they wanted, and it's part of what makes our day fulfilling. Right?
It is, and it's when someone says, "I didn't realize that," that was doable. And this actually, it's not commercial, it's residential, but lending is lending in a sense. I was talking to somebody yesterday, and this was actually fun, goes to the question. I play squash, and the guy was playing squash. We were talking about their home loan, and he's on a 15-year fully amortizing loan, which is great because you pay your house off quicker. But as we started the conversation earlier, life happens, and what I recommended to him, and we can do this to some extent in commercial, is with a residential loan you can always pay more than you have, right? So my recommendation to anybody with a home loan is don't go for the 15-year fully amortized. Go for the 30-year fully amortized, and you can still make that 15-year payment, but all of a sudden your child didn't get that scholarship and now you have this tuition bill. So be prepared, think ahead about things that are unexpected. You can still pay the home off in 15 years, but don't be forced to do it. And we can do the same thing on commercial real estate. Typically there's prepayment penalties, but there are certain lenders where you can make extra payment a year or other ways to pay that down quicker.
That's a great point.
Alfred on Facebook gives a thumbs up to both the Bay Cities team and the...
Thank you, Alfred.
Thanks, Alfred.
Another question. Rachel, I think it's for Avi. She asks, Avi, do you miss being in the medical field?
I'm still a part of the medical field. One thing I love about Tauro is that you don't have to be in your office all day. You can really travel around the world and explore and still do your job and be good at it. And I still am part of the medical field. I go back to Israel whenever I can to volunteer as a medic. I was just there for a year last year. I was a training officer. I trained international volunteers that came in from all across the world to volunteer in Israel, and I was the training officer, so I had a great time training them. And you never really stop being a medic. All the time people come up or they get hurt and you just want to help them. It's just part of who I am at this point. So Rachel, I'm still a medic.
Cool. Awesome. Jake wants to know, is investing in multifamily properties worth it?
Absolutely, if it makes sense.
Yeah.
The right deal, right?
Yeah, the right deal for the right person. Really sit there and look at yourself and look at your goals, and you can get owning the 50, the Hawaii City Plaza, the 50 floor, condos, but you gotta start small. So whether that be with a single family, duplex, triplex, fourplex, start small. Start with something that you're able to control and manage. That's the most important thing. Controlling and managing, what you have, will allow you to be a lot more successful in the future than having to constantly worry about, how I'm going to keep up with payments. And, things break all the time in multifamily. So, you're going to get the experience, you're going to get more comfortable with it. And once you do, it's a beautiful thing.
I think this next question is for Alice. Alex Luce wants to know, what other future episodes are you working on?
So we're going to be working on an episode that talks, I want to dive in a little bit more into the ordinance. I think that the seismic retrofit ordinance, by the way, in LA, I have I've attended quite a few seminars with the Structural Engineers Association of California, Southern California, and there's some issues with the ordinance that it doesn't cover. I don't think that folks are aware that even though they have a design that's compliant with the city, that it gets approved by the city, I don't think that they're aware that the property is still at big risk in suffering severe damage. And I think that this is going to be a very hot topic moving forward, especially with the lenders and the insurers, because they think that it's this ordinance. Most people think that this ordinance is going to make their building earthquake proof. And it's not. The ordinance is really made to prevent the building from collapsing. But if you have paper on a building, if you're the lender, you could still be lending on a building that's going to suffer red tag damage or yellow tag damage, right. And being able to assess that risk is no one's really looking at it right now, right. In the right way. So that I want to dive in a little bit more. We're going to probably do a few more discussion shows on the seismic retrofit and stuff. And we've got some case study stuff. We've got some crazy looking buildings that I want to share with people. I think they'll be interested in seeing what that retrofit's going to look like.
This next question is for the Tauro guys. Brent wants to know, why is financing in Hawaii so hard to obtain?
You want to take this one, Steve?
Sure. Well, it's It's a little bit more difficult because one of it is labor. So if it's construction, there is a labor shortage, and people do bring in workers over from the mainland, but they have different regulations, not federal regulations, but more state, and how the banks look at it. It's somewhat territorial, actually. They also really don't like foreigners, and when I say foreigners, that means anybody outside of Hawaii.
Right.
So it may be the Aloha State, but it's not always such
To visit.
Yeah,
To
right.
visit, not
Right.
to-
You can spend your money there, but
Don't take the
Right.
local capital away from the people.
yeah, and their economy is a little bit different. I'm not all that familiar with Hawaii as I am with other cities, but it's a very tourism based economy, and that's shifted over the years. And this is a condo project. There are other condo projects coming out of the ground, so you have to justify that. So all those combined make it a little bit more difficult. The other thing is because it is Hawaii, not all the lenders will go there. Wells won't go there, Bank of America won't necessarily go there, so you're confined to the lenders that are there. We actually are doing this loan with a Canadian lender.
That's amazing.
So,
That's amazing.
yeah.
Canadians are interested.
This next question is from David. He wants to know, is Tauro hiring?
We are hiring, and so David, please contact us.
We'll post the contact on
Yeah,
the.
and currently we're hiring people like Avi. I was very fortunate to find Avi. It's funny when we were looking to hire, and it was very quickly that I wasn't looking to hire just somebody. I was looking to hire an Avi, so he was great. So
Awesome.
we're looking for people. Just to give you just a general, right now we're looking for capital advisors. That would be people that have experience in real estate. Ideally, it would be somebody with another company that wants to make a shift, maybe somebody with a lender that wants to make the shift, because if you're with a lender and somebody comes to you, you only have one solution, which is that
That's right.
lending from your with their company. We will have 10 or 15 solutions. So yes, we are hiring.
Cool.
Rick wants to know, are there any horror stories or bad experiences in the lending world?
Plenty.
Yeah, all the time.
Yeah, there are plenty, and some of it is
Call me and I'll tell you.
yeah, some of it is actually having the wrong lender.
Wrong loan, wrong lender, wrong place, wrong time.
Yeah.
Avi Luz wants to know, have you been back to Iran to visit family?
No, I have not. I actually grew up in the States. My parents were from Iran. They are not allowed to go back.
It's a one-way. That's a one-way
Yeah, it's
ride.
one-way ride.
Nobody else.
79, everything changed. Yeah.
David asks another question. He wants to know, are there any type of projects that you won't take on?
Sure. The projects that we won't take on are projects that we know we won't be successful. And part of that is all the things we talked about before about being realistic, being organized. And let's face it, in any business, there's some personalities you just don't mesh with.
Sure.
So, life's too short. So we want to make sure that we can really accomplish what we do. We tell everybody when they come on board, it's not about the commission. So we're not going to just do something because we think we can get paid. It all goes back to that level of care that we talked about. And everybody that comes on board understands that. Well, we always tell them at the end of the day, when you end your career, and we talked about this earlier, when you end your career, it's not about how much money you made. It's about how many generations of a family you do business with, or how many degrees of separation you get referred to. So that's all part of it. And so, we will turn down loans because we want to make sure they can happen. But if they're not realistic, we can't do it.
Yeah, we're trying to help you, and at the end of the day, reach your long term. We want you to come back to seek our advice, and the only way we know to do that is to help you the best we can. If we can't do it, we'll just tell you outright. Yeah.
Jessica on Facebook has a pretty interesting question. She wants to know, me and my husband are trying to venture into real estate investing. Should we take a commercial or a multifamily route? What are your suggestions?
Well, I think it really depends, and Avi alluded to that earlier about management, because there's different degrees of management associated with all the different product types. I think it's a great question. I think you should do some reading about the various product types and what it entails. I do, again, think you should look at Rich Dad Poor Dad because it talks about various types of investing. But as Avi talked about earlier, start small, start something you can handle. I would make sure you stay local as opposed to, hey, I heard about this great deal in Phoenix. Stay local first, understand what it's all about, and then move on. So it all comes down to what you're trying to accomplish.
Awesome. And I think there's one last question from Jacob. He says, Steve, you mentioned Rich Dad Poor Dad. Are there any other books you recommend?
There are plenty of books to look at, but I think that's the one that's simplistic, especially for people starting.
It's definitely a 101,
Yeah.
like a real estate mindset 101 type of book, right?
Yeah, and realistically, you could Google, real estate investing, and just try to keep it simple. The other thing that I would recommend is there are websites like RenTV or Connect, and various seminars that you can go to and learn a whole lot. And then you also are with like-minded people,
Sure.
and people that are either more advanced or not as advanced, and so you'll learn a lot. And one of the things about real estate that I found, and like I said, I've been doing almost 30 years, most of the people are really helpful. They've all been in your spot before, so they all started somewhere. They all made their first investment, and so I just go to many of those as you can and ask as many questions as you can.
Yeah, I think regionally here, like if you're interested in apartments, you can visit the Apartment Owners Association. There's the Apartment Owners, so there's two here in LA. There's the what is the other one, Brian?
Apartment Owners Association is one, and the Apartment Association of Greater LA.
Of Greater LA,
Correct.
that's right. Yeah, those are two, if apartment wise, right? So I mean, there's a difference of involvement and engagement between residential and commercial, and I think, like you said, people have to just kind of get their head around each one to understand it enough to see which one is a
Right.
better line with what your goals are, right?
Correct.
Cool. Is that it? Is that our last question?
That was it.
Well, hey guys, let me just kind of remind you that we have a blog article. You want to learn more about software retrofit? Please go on to softwareretrofitpros.com. And we got a little slide here for you. We got dozens of articles on there. If you want hundreds of articles, go to baycitiesconstruction.com. And those are more for general construction topics. Okay, for those of you who don't know, we've been in business for a long time, 15 years. This year's our 15th year. I'll probably give something away for our 15th year anniversary, but I'll tell you that in the future shows. So we can help you with architectural engineering and city representation for all of your projects. You want to get a hold of the fellas, we'll post their information. Please don't forget to subscribe. Click below and like us on Facebook and subscribe on YouTube so you get alerted when we have a new video up. This is our contact info. You want to find out what the planet is saying about us, go on to Yelp and Houzz and all those good spots. I want to give personal thanks to our friends at Tauro Capital. Thanks, Steve, for coming by.
Thank you so much.
Avi, man,
Thank
that
you
was
for
awesome.
having us.
I
Yeah,
hope you guys
great.
enjoyed it.
Yeah,
And
fantastic.
we look forward to bringing you folks a new show next week, something that's going to be informative and you're going to get a lot of value out of. And by all means, if you still have questions, post them below, and we'll forward them to Steve and Avi and get those questions answered. If you have any questions for us, by all means, post them below, and we'll either Brian or I will hit you up. So, hey, thanks for being with us on this show. We'll see you next week. Take care. My name's Alex Rodriguez, reminding you, you don't need a contract. You need a team of pros.